Good morning, everybody. My name is Tor Østergaard with HC. I'd like to welcome you to this Q2 presentation with Michael Skov, the CEO of Hafnia. We will run through a number of things in the next 30 minutes, but please ask all your questions. You can put them in the chat below and I'll ask them accordingly. We will run through the Q2, some of the dividend, of course, the order book, and perhaps a little bit on Russia and what's happening there, and then, of course, the rest of the year. Welcome, Michael.
Thank you so much.
I'd like you to introduce Hafnia just briefly before we proceed. If there's anybody who's not seen these presentations before, please.
Yes, absolutely. So Hafnia is a shipping company basically focused on transporting refined oil. So we own and operate product tankers. As you can see from this slide here, basically we have a fleet, an own fleet of about 128 ships, including what we have chartered in, which are ships that we're leasing. But we operate above 220 ships totally, which means that we are also operating other owners' vessels, managing them commercially on their behalf. So that gives us the position as the largest operator of product tankers on a global basis. The company has an average age of 7.9 years of the fleet. And the reason I highlight this is that it's an important factor, considering that the overall product tanker fleet globally is around 11.5 years old. So as it gets older, it's important to maintain a modern fleet, which is something that I think we'll discuss a little bit later on in the presentation. We're listed in Oslo on the Oslo Stock Exchange under the ticker Hafnia, as you can see on the bottom of the page.
The only thing I wanted to ask you here, Michael, is that the NAV, the net asset value now is 75.65. That must be all-time high.
That's correct. That it is, yeah.
And also, just for those who don't perhaps know, the market value of the company is now close to 32 billion Norwegian kroner. So that's just the brief introduction here. But let's dig into Q2, Michael, please.
Yeah, so as you can see on this page, I mean, Q2, despite the fact that it normally, on a seasonality basis, is not one of the strongest quarters of the year, we still managed to come out with a net profit of $213 million. And that means that the first half of 2023 was actually stronger than the equivalent first half of 2022. One of the areas of measurement is what you see on the below part of this slide, is that we had an average time charter equivalent earning of 33,449. So it's a very good quarter, and it just kind of underlines the strength that the product tanker market has now been in for over 12 months. At the same time, we're paying out 60% of the net profit in dividend. So that's part of our dividend policy. And I don't know if you want to speak about the dividend now or later on.
But that's because it's such an integrated part of your giveaway to shareholders. So the only thing, there's a link between loan to value and how much you pay out. Maybe it's time to just briefly describe that, please.
Yeah, so maybe just to quickly talk about the backdrop of our dividend policy. Hafnia has grown a lot because we're a young company over the last 10 years, but particularly the last 3 years, the assets that we acquired were quite substantial. So we kind of finished our growth strategy, bringing us to that global leadership position that I mentioned. So that means that the focus now is really on returning capital to shareholders. We don't have any big investment projects, no capex upcoming. We do want to reduce our debt at the same time. So that's the balance you always need to be aware of. So the dividend policy is based on our net loan to value. And as that reduces, the dividend goes up. So basically, at 30% and above net LTV, we pay out 60% of the net profit to the shareholders. When it falls below 30%, we pay out 70%. When it falls below 20%, we pay out 80%. And by the end of this quarter, it was 30.1, so just above the threshold. And that's not artificially made numbers. It just happened to be so close. Just to be clear, we didn't try to avoid paying out more. But what that means is, of course, that after the next quarter, the dividend will increase from 60% to 70%, the way it looks now.
Okay. and it will be paid out. I just checked out on the 31st of August is the ex-dividend date, so in very, very short time.
Correct.
Yes. And the way I see this is that you are actually now paying approximately 18% of your in dividend yield, if I just do the math. Isn't that
Yes.
around that?
Yep, that's correct.
Okay, cool.
So we basically paid out close to $600 million the last 12 months in dividend. Yeah. So it's been quite substantial.
Yeah. If you have any questions to this, then let's continue, Michael. Is there anything more to the cash position? We covered net loan to value and stuff like that. Is there anything on the balance sheet that investors should be aware of?
No, I mean, not other than, as I mentioned, that we are still trying to be prudent on both sides, right? We do appreciate that in our market and being asset heavy, that you do want to reduce your debt as well, which is what we're doing simultaneously. But I think what's worthwhile noticing here is also that when we talk about the return on invested capital and return on equity, etc., we are and have been consistently outperforming the average of our peer groups on the return numbers. So that's a super important part as well. One thing is to do well in a good market, but we measure ourselves relative to our peers because that's a competitive environment that we're in. And the only other thing I'd say about the balance sheet is that we still have access to very, very cheap financing. So we do want to be prudent in the capital structure going forward. We've hedged about close to 70% of our interest rate exposure at around 1.6%. So I think we're overall in a very good position also from a balance sheet perspective.
Cool. I'll just jump a little bit to going forward, because this is your fleet coverage for the remainder of the year, and it says here it's approximately 78 for Q3. We're now in the late August, so you must have a very good feeling for where we are in those kind of things.
Yeah, and exactly. So Q3 is considered, the weakest quarter of a year, right? So it's not a surprise that you'll see slightly weaker numbers. I think the good news is that we've seen the weakest period in the beginning of the third quarter. So we've seen strengthening here during the last period, and as we speak, basically. So we do expect that these numbers will improve as we see now that the trends in the markets are definitely going upwards.
Cool. Maybe just spend a little bit time on this one, because that's always the puzzle with Hafnia. I just mentioned that you're trading on 32 billion Norwegian kroner, and it sounds very impressive. That's not it, but you're making a lot of money in dollars. So I think the PE is around 3 or something like that. And
yeah, that's right.
When you have discussions with investors about this, institutional investors, what do they say? Why is it the PE 3 and not 6 or 8?
So I think actually it has a lot to do with the historical, the history of shipping in general and the listed stocks in the shipping industry. So when we look at the history, basically the cycles have been rather short. And I think there's been this tendency of measuring values of shipping stocks versus the net asset value. So you very often see reference to pricing of stocks up against the net asset value of the business. And if you look at that historically, that might have made some sense, because basically whenever you had strong markets, you also had the ability to build a lot of new ships that would come very soon. So therefore the cycles became shorter, and therefore you can argue, how many multiples do you want to price a listed stock on going forward? So I think what the difference is now is that we're in a very different situation. And I know you have some slides later on, but at least as a backdrop here, I think when we look into the future, this is not a short-term or one-year thing. We are unable to build and buy ships, no matter how much we try, that will ruin the supply side of this business for the next 3 years, 4 years at least. And therefore you can say on a multiple basis, it looks extremely low, as you say, around 3, even 2.9, I think we are at the moment. So I think it's probably more about trying to explain, as we are doing, to investors, why we have a lot more run rate in a very strong market now than what we have seen historically in this sector.
Yeah, because one of the key things I wanted to ask you here is that obviously you also watch what's going on in container shipping and stuff like that. Do you think there's a link between the fact that you have these huge changes in container shipping and then over to Hafnia. Does that impact your investors? Do they understand the difference between the product tank and the container market, for example, at this stage?
Yeah, I think most definitely do. And I think the great thing about the container market, as far as compared to our market, is that the container market have ordered so many ships that they're basically taking out any shipyard capacity for the next many years. So this is actually a key reason why we can't ruin the product tanker market by ordering too many ships. This is what you've seen in containers. This is what you've seen in different sectors, that ordering too many ships in good times ruins the market after 18 months. It's impossible to have it in the product tanker market. It just can't be done because there's no room on any shipyard to have any new orders until very late 2026, and it's being blocked out as we speak already. So that's the big difference. So I do believe that investors understand that, but I also think it's something that we as owners, of course, we have to explain these stories, right? We have to spend time explaining what is actually going on.
Cool, but then let's go into that, because that's of course, the name of the game, to understand the long-term demand supply situation, and this is the demand. And I guess one of the key things you always tell me is that the demand for oil is not going away; it's going up. And maybe you could just, you've highlighted these two red boxes. Maybe you could explain a little bit of why.
Yeah. So you're right, first of all, on demand side, right? And we saw in June the highest consumption of oil that we've seen ever at 103 million barrels per day, right? So definitely oil demand is not only back to pre-COVID, it's going further up, and expectations are it will continue to go up even next year and the year after. So just to keep a focus on these two things is that we've never had a demand problem ever in the product tanker market. It's always been ruined by supply of ships, and this time around, those ships are not there and they cannot come for the next many years. That's the main thesis. But on the demand side here, what we're simply trying to illustrate is that what we are seeing now as we speak is that loading of refined oil products. So basically, we track data of how many barrels and tons of refined oil goes on board ships all over the world. So what we can see already now is that we are here in the third quarter, which is traditionally the weakest, as I mentioned earlier. We're already now seeing refined oil products loaded that is above what it was in the fourth quarter last year, which was a very, very strong quarter. So what we're seeing now is that demand is accelerating, and it's not just on a theoretical basis, it's actually real oil that's coming into ships, which is also why we're seeing the market as we speak showing more strength already. So it's almost an early winter market, you can say, that we're seeing now when we look at the data of how much oil that is now going on board ships.
So the way, that's the demand side, and then there will be, let's just take a little bit of look at that, because if I read your sort of forward-looking statement, you say, there will be a strong Atlantic trade, there will be coming in more demand from China. And one of the key things everybody is discussing now is the Chinese economy, and there will be something going completely wrong and stuff like that. How do you see this in relation to Hafnia?
So I think when you look at China and the product tanker market, it's not a massive driver, quite frankly, right? So if you look at China versus container business versus gas business versus transportation of crude oil, China is a very, very important factor because they are the largest importer of those commodities. They are not a large importer of refined products at all. So what we get out of China is really when they have excess oil. So in other words, actually, when they're not consuming a lot in China, they're exporting more, and that oil we would be transporting. So it's more of an export area for us, and that is not necessarily linked to whether the economic growth is strong or weak. In an actual fact, in a weaker scenario for China, could mean that they have more excess oil, refined oil, that they want to export. So that's kind of the story on China for us. When it comes to the Atlantic basin that you mentioned, the key element to watch here is that by the end of last year, there was a huge buildup of inventories in Europe of diesel oil in particular. And those inventories, as you have, I think you have a slide on it as well, have been drawn down dramatically. So we have not, you can see it here on the top right, we have not seen the effect in the product tanker sector yet the full effect of the lack of Russian diesel oil moving into Europe and now being replaced from other areas. What we have seen is that some oil has gone in, but mainly Europe has used inventories to draw them down. So what we have in front of us is a replenishment of refined oil that has to come longer way because it doesn't come from Russia. So we have more ton miles still to gain from that story than what we've seen over the last 12 months.
And then let's just perhaps go back and go into the supply side, because if you just read the headlines in the product tank, you will see that there's been a slight pickup in the ordering book, and I think you mentioned 9.5%. I think that's the full length of it, right? So
Right.
maybe you can just explain, how do you see this supply and situation in comparison with the demand?
Yeah, so even at an order book, as you said, at 9.3%, but again, it goes out including 2026, right? So I mean, we're talking about 4 years. So that's a tremendously low level. I mean, those numbers used to be average numbers for a year delivery, which is now spread out on 4 years. So there's no doubt that there is a deficit of supply vessels still, even including this order book, and even if more comes. There'll still be a lack of ships for the next, at least in our view, 3 to 5 years, without any doubt. I think the challenge at the moment is that if you buy a new product tanker for delivery in 2026, you're paying the highest price ever seen for a new build. That's how high the prices are. You have to assume that a vessel has a 25-year lifetime, which means that you're well into 2050 before that ship needs to get scrapped. So it's a very difficult business case to present to your owners, stakeholders, whoever they are, that it's a good idea to buy at the highest level ever a vessel that will live well into a time where we all expect, coming out in 2040, 2050, that oil demand will reduce, and therefore how much demand will there be in 20 years for product tankers? That's a different story. So that's why you have not seen excessive ordering within our sector, like for instance you've seen in dry bulk or in LNG or in containers, which doesn't have the same problem that we have, which is that we're transporting fossil fuels, which eventually out there will be less than what we see today. So that's what's keeping the order book from growing, and we don't see at all any massive ordering in this sector in the foreseeable future.
Cool. If there's any more questions on demand and supply, I will follow up. There's been a number of questions on your fleet, and I'll get back to that, I promise. So if we just finish this, what you say is that there will be a better market in Q4 and potentially into 2024 and 2025. I've asked you this a number of times, if there's anything you see as a disrupting factor for this view.
Yeah, well, I think, as I mentioned earlier, when you have the supply side in control, which is what we have full visibility basically throughout 2026, then the real risk is really on the demand side, right? So if you ask me to pinpoint something, then I would say, well, if the world goes into a really deep recession, very deep, and we're basically talking almost like a Corona type situation where oil demand drops significantly. And when I say significantly, I mean like 10-15%. So serious. That obviously would have an effect on our markets. It's not a scenario that we see, but it should be mentioned. And that's really the key element here, is that oil demand going down dramatically within the next 3 to 4 years is kind of the only risk factor I would point at. Supply side, it will only get worse in the sense that there will be less and less ships because the fleet is aging quicker than we can replenish with new ships.
Cool. So if you just finishing up on this industry part, if you order a ship today as Hafnia, when will you get it?
2026.
2026. Cool. I will just skip to, I think we just need to touch upon this Russian thing, because there's, all kinds of things. We talked about it a couple of times, that it's not really something it's on top of your agenda because it's a dark fleet and stuff. Could you just perhaps talk us through why is this not relevant to Hafnia in a big scale?
Well, Well, you can say it's relevant from the point of view that it takes away ships, right, from the international markets, which is good. So that basically means that you take vessels out that can only trade in the trade with Russian oil, right? So basically what that has meant is that we, of course, have taken out a lot of ships that are substandard and to be involved in this trade. For Hafnia, it's not relevant since we're not trading Russia at all. So this has now become an isolated trade. The good news is that a lot of these ships will never come back to international trade afterwards. And most of these ships that are older as well will, once they're finished with this trade at some point, will probably go to the scrapyard. That's the thesis.
So investors in Hafnia shouldn't get nervous when the Black Sea is bombed on VLCCs with from Turkey or somebody. It's a low risk for Hafnia overall.
Yeah, but I think also, I mean, so the Russian trade is one thing, right, with the fleet and the vessels that is trading Russian oil, because that's, as you said, the dark fleet. Trading in war or warlike zones, which is not really only a Russian related, because it could be a bypassing an area, is not something which is necessarily new for shipping companies. We've been trading all around the world, so sometimes you're in areas. So this will just be what I would call, I mean, Hafnia would never do anything that's outside what I call just normal trade. But sometimes you'll be trading in war and warlike zones, but that would be depending on what is the situation, etc. But obviously, going into areas where there is a war would be a complete no-go for our vessels.
Sure. Cool. I think that there's a number of more detailed questions I'll ask now, Michael. So if you have more
Sure.
sort of relevant demand, supply, or financing, I'll take them from one. There's a question on the appetite for divesting more of your 2008 builds. It's a very very specific question. I don't know if you can answer that.
Yeah, what I can say is that we are constantly looking at modernizing our fleet, and we've had a good, I would say, modernization over the last 2 to 3 years, where we sold off a lot of ships built 2003, 4, up to 2007. So it's a good question because we're now getting to 2008, so to speak, right? So we are actually, as we speak, looking at also divesting, a few of these vessels. But that's all on a case-by-case basis, and obviously when markets are good, the price for selling these assets also has to be strong. But we do have a fleet renewal strategy that would indicate that 2008 ships are also eventually going to come out for sale one by one. But it's not going to be any massive block sales or anything like this. We just kind of take them really one ship by one ship as we go along.
And then there's a question on the motivation for the recent vessel purchases you've had and how you see the vessel valuations going forward.
Yeah, so the recent acquisitions that we've done, if we look at the second-hand ships, were really based on a combination of price and a combination of the quality of the vessels. So they're all chemical IMO 2 vessels, which is an area that we've personally, and I feel as well, have a much longer path than just traditional refined oil. So what it means is that these ships can not only transport refined oil products like diesel oil and gasoline, but they can also transport easy chemicals, which is a growing area, and we see that as more flexibility. And the prices we saw were interesting. Those were like more distressed purchases. So it's really a combination of price, but very much also the IMO 2 capability, which you can see in general that we had a lot of strong focus on. And if you look at the earnings of these ships in our fleet, it's quite remarkable that they're earning not only the premium that they need for justifying the slight extra price you pay for that feature, they're actually earning more than what is needed to justify the investment.
Cool. And about the valuations coming from here, how do you see that? I guess it's your NAV we are discussing.
Well, we think that if you kind of take it in the context that I mentioned earlier, that you can't have any new ships coming until 2026, and you have an oil demand curve that keeps on going up, and ton mile has been increasing, our view is that second-hand prices are going to continue to be strong. because that's the only place you can go. You have no other alternative. If you want to be in this market, you have to buy existing assets on the water. And as earnings are as high as they are, our view is that asset prices are going to continue to be strong, and we also believe that asset prices will actually go up as we approach a winter market this year.
And in relation to that, there's a question on if you have any options in 2024, you can call.
We do. So we do have quite a number of time charter vessels with purchase options on, and I think it's about 4 to 6 at the moment. So that will be a constant evaluation whether we want to continue with the time charter or we will exercise a purchase option. But we do have that, and I think overall, I think we have about close to 10 purchase options on the fleet that we have chartered in so far.
Okay. Then there's a very specific question on your bunker operation, which you have in-house. How come you have it in-house, and why is that relevant to you as a company?
Well, it's in-house because we basically built it from scratch. So you can say that we hired the team to help us actually establish a bunker procurement department, because we were very focused on this area, knowing that we are going into a future where there's going to be a lot of new things coming in play, including biofuels as a blend, dual-fueled vessels that will be burning LNG, methanol, etc. So how you procure and how you ensure good quality and follow up on this was important. So that being said, it's not a necessity for us to have it in-house as such. We just keep on developing it. So what we have today is actually an alliance which has more than 1,000 vessels that we are procuring bunkers for a lot of different owners. So we don't really see it as anything that's kind of, let's say, Hafnia dominate or control. It's an alliance between equal partners, and everyone gets the same benefit. We don't get any extra benefit versus all the others. We all share the benefit of having scale when we buy bunkers.
That's cool. I think I ran out of questions now, Michael. So that's good, because we are finishing up within the 30 minutes. Do you have any final comments to shareholders here?
No, I think the only thing, as I said, which I think is important to focus on, is not to get stuck too much in historical development of product tankers in general, but more look at the supply side. This is really the key issue. And I know I repeat myself, but I do think it's important to remember this business in my 35 years has never had a demand problem. We've always had increased demand for transportation. The big issue was always supply vessels. Every single time we've had a market that's dropped, it's been because too many new ships came in. That cannot happen for the next 3 to 4 years. So I think that's really the length that people should be focusing on.
Wonderful. Thank you very much, Michael, for your participation, and thank you very much to everybody who's been in here today, and thank you for your questions. I hope you got them answered. Thank you very much, and have a good day.
Thank you so much.